Hey everyone, Patrick Jackson with Mann Mortgage here with this week's market update. Today is August 25th, Thursday. It's about 10:45 on the West Coast. The stocks are up today, down over the last week. Same can be said for mortgage-backed securities, which affect mortgage rates. We've had a good day today, which is nice to see after a pretty bad week. In fact, if you go back to August 1st, a national lender survey which measures, the average 30-year conventional rate that's being offered to good borrowers. It was at about 5.05 on August 1st. Today, this morning, we're at 5.81. So over the last 3 weeks plus, we've gone up about 3/4 of a point, which is obviously not what we'd like to see. So hopefully it starts heading back down in the right direction soon for all of us. As far as market direction, very important today, tomorrow, actually a huge day. In the morning, we're going to get inflation data, the PCE, which is the Fed's favorite measure of inflation. And like we've talked about before, inflation is bad for rates. So depending on how that report comes out, that can often be a market shifter, something that will affect mortgage rates, quite a bit sometimes. So we'll be watching for that and see what happens in the early morning hours. And then after that data comes out, Jerome Powell, who's the Federal Reserve chairman, he'll be speaking at the Jackson Hole Economic Symposium, which I didn't get an invite to. I'm not sure if you guys did, but he's speaking in the morning after he gets this data. And just anytime he speaks, that can be a huge market and mortgage rate shifter. He has a lot of power over the market. So depending on what comes out of his mouth, it kind of might determine and will probably determine what direction mortgage rates head in the near future. So he'll be talking armed with that new inflation data. So it's going to be very important to see what he has to say. Be very interesting. And like I said, that could have a very big effect on the market. So tomorrow will probably either be a really good day or a bad day, depending on what he says. Generally, it probably won't be neutral, if I had to guess. Moving on, I wanted to share this quote real quick from Lawrence Yun, who's the National Association of Realtors chief economist. I always have a hard time with that word for whatever reason. In terms of the current housing, so basically what he's saying is he thinks that we're close to the bottom of the contract signing cycle. So, contract signings have been down, pending homes are down, new home sales have been down. So he thinks we've kind of reached the bottom of that point, where the low point. So basically, he's connecting the modest decline, which I think it was down 1% as the pending home sales that came out yesterday, connected to my industry, to mortgage rates going up, and that's definitely true. With rates going up, it's some people aren't qualified anymore. Some people just decided they don't want to move or to take on a new rate. So definitely our rates have had an effect. He also points out that inventories are growing across the country, and again, this is national, not local to Oregon or California. Inventories are growing for homes in the upper price ranges. But there's limited supply at the lower price ranges, which is hindering transaction activity. So something we've talked about, a little bit of a recession activity. Since there's not that much where people are looking, then that's going to, obviously limit what can be sold. Home prices are still at this point appreciating at double-digit figures, but he expects that to go back to more of a typical rate of 5% by the end of this year and in 2023. And I would agree with that. That's kind of, in our industry, that's what we kind of believe, more the historical 3, 4, 5% average, not the 20% plus that we were seeing, over the last year or so. And then he talks about, mortgage rates. He expects them to stabilize in now near 6% in the near future. And then along with job creation, that should create more home sales for next year. That's something debatable. The job creation will be interesting to see what happens in the country as far as a recession, not a recession, and all that, inflation, all that kind of stuff. But, it's definitely a good outlook. And hopefully that all comes to fruition, and we shall see. So the last thing I want to talk about is, talking to realtors and borrowers, in fact, across Oregon and California over the last few months. One thing that I've seen that's been, a big concern for agents especially is borrowers, because of the rising rate environment, borrowers no longer qualifying for loans, and making the deal fall through. So obviously that is a legitimate concern, especially I get, from both sides, the buyer's agent and the listing agent. I've seen some interesting contingencies attached to that to make sure that the people, keep things going. But I wanted to make a few points about that. First of all, a responsible lender, especially in such a volatile rate environment, should not be qualifying a borrower down to their very last dollar. So we have our qualifications that borrowers have to meet in regards to like debt to income and stuff like that. And it's really irresponsible in such a volatile environment for them to max out so there is no room for the rate to go up. So, what a good lender would be doing is you build a cushion into those ratios, into the qualifications, to make sure if things change, then there's room for that, a contingency. Like sometimes you get it in other situations. So, that's the first thing to say. And the second thing I would say is that, again, a good lender with the way the markets have been, especially lately, should be really, really, really paying attention to the markets and to mortgage rates, how their pricing is going with their company. And, especially once they're in contract, their borrower's in contract with somebody, they shouldn't they should lock that rate as soon as they can. If they qualify, they're in contract, they shouldn't be playing games and playing chicken with rates to see what happens, especially if their borrower is right up against that. If the borrower has space, great. Maybe you want to see if you can get the market on a downturn and get a little bit better rate for your client. But if they're very up, if they barely qualify, and if things go the wrong direction, they no longer qualify. Again, it's just not very responsible for a lender not to get them locked in, not to explain to the borrower that, hey, we need to get this wrapped up, or else you might lose this home. And buying a home for people is such an important investment and such an important part of their life. You can't play games with that. You can't drop the ball. And so it's just kind of, like I said, especially where rates where they're at with our industry, with activity being down, they're not too busy. So they should be on top of these things. And I can't imagine, it's just unimaginable to me why this happens so often, given everything that was going on. So get off my soapbox. But, if you have, if that's happened to you, or you have a client you work with that's happened to you, I would suggest getting a new lender, one that's going to be a little more attentive to your clients, because again, that's such an important thing. With that being said, if anybody needs anything at all, I'm always available. I'm an attentive guy. I pay attention to the markets, and that would never happen. So, if anybody needs anything all in regards to that, if you want to chat, you have any questions about programs, feel free to reach out, and I'd be more than happy to answer them. Have a great day, guys. Thanks.